Welcome to the Peripheral View. My name is Professor Alfonso Severos, and this is my weekly video series addressing those issues on the peripheral edge of the news. Wealth tax, how the rich stay rich and get richer. During the pandemic, approximately 800 billionaires in this country made additional profits of $1.2 trillion. They made $1.2 trillion during the last close to 3 years of the pandemic. This was going on while many Americans were barely surviving and only able to survive because of stimulus checks in addition to unemployment insurance. We see these discrepancies that's built into a system that's designed by the rich to benefit the rich, especially the tax system. The progressives have been asking for a wealth tax, a system that tax the most wealthy individuals in the country, a system that taxes assets and not necessarily income. Because most of your billionaires who run major corporations, who you hear about paying no personal income tax, is because they don't receive a salary. Their money basically comes through capital gain. And so they're looking at a wealth tax on personal property, cash in the bank, real estate, investments, anything of value. Because rich folks don't receive incomes basically like a salary check. The super rich, their monies come from through this system of capital gain. And we have a tax system that benefits the rich, or those who those who monies come through capital gain. You can think of capital gain as selling an item for more than what you brought it for. That's capital gain. Capital gain is on stocks and bonds, on precious metal, on real estate and property. If you're receiving money from all these things, it's not treated as income. It's treated as capital gain. And the tax on it is different from the tax on income. So capital gain is taxed anywhere from zero, no tax, to 20% maximum. So if you receive $50 million a year from investments in stocks and bonds and property, your tax rate maximum will be 20% and probably much less. However, if you work every day and get a weekly paycheck, your tax rate starts at 10%, and it can go up as high as 37%. So we see discrepancies those whose monies come from capital gain versus salary. So if a person works and makes $100,000 a year income or salary, they will be in a 24% tax bracket, as opposed to someone who do not work and has a trust fund of $100,000, and they get $100,000 a year from the trust fund. Their tax rate will only be 15%. So we see these discrepancies, and that helps contribute to and maintain the wealth gap. In 1970, 10% of the wealthiest people own 1/3 of the household wealth in this country. That's 1970. 10% own 1/3 of the wealth. Today, 10% owns 75% of the household wealth. So if you took all the wealth, the value of all the households in America, and came up with a dollar figure, the top 10% own 75% of that figure. 1/10 of 1% has as much wealth in this country as 90% of the people at the bottom. So 1/10 of 1% has as much wealth as 90% of the bottom 90%. And 60% of the wealth is inherited. It's not done through hard work. It's inherited. It's passed down from generation to generation. To give you an example, the Walmart family has more wealth than the bottom 42% of the population of the United States. Senator Elizabeth Warren, Senator Bernie Sanders, and many progressive Democrats have been proposing a wealth tax, a 2% tax on everyone who have monies over $50 million. So if you have $50 million, you're in damn good shape. And the progressives are proposing a 2% tax on everything over $50 million. And this 2% tax over a 10-year period will bring into the federal government approximately $2.75 trillion. $2.57 trillion. Now, that's the combined cost of both infrastructure plans. The roads, the bridges, the highway, the broadband, plus the increase in the human Build Back Better plan with child care, everything that's involved in that, can be fully paid for just by a 2% tax on those who make over 50 million, who have over 50 million over a 10-year period, because the infrastructure plans are over a 10-year period. So we see it's when you hear people talk about the deficit and so increase social spending and increase federal spending, we can't afford it. Well, we can't afford it because you're not dealing with an equitable system. You have a system that's designed for those at the top end up paying no income tax, with those at the bottom end up carrying the bulk of the weight. And not only is this system designed for individuals this way, but also for corporations. So a tax system designed by the rich to benefit by the rich. And because they are rich, they're able to influence those who make the laws. And they do for their benefits. Thanks for watching. I hope this has been useful and understand this idea of wealth tax and taxing capital gain as opposed to just income for the super rich. If you like this video, please go to YouTube and like it and subscribe to Peripheral View. Thanks for watching.